Right, we are able to move on. We can tick off number 5. We're finished. Let's do number 6. Now, number 6 relates to our gross trade receivables and it relates to our outstanding amounts on credit sales. Okay, so guys, when you look at the line item, our gross carrying amount, 2010. When you think about sales, remember, we will already include that sales amount in our taxable income. Therefore, this is already taxed. Therefore, there can't be any taxes. We have our carrying amount and our tax base, which is equal. Okay. Then our trade debtors, allowance for expected credit losses. Important here, guys. Let's have a look at the note. The gross trade receivables do not contain a significant financing component. A tax rate of 40% applies, however, not used. Therefore, this is an easy error. We need to indicate that they did not use the 40%. Let's immediately transfer this, and this will be our number 4. And this will be in terms of our allowance for credit losses. For credit losses, and they've indicated to us that the rate was not used and our tax base is incorrect. Okay, but what is the correction now when we look at this? We know that our tax base should be the 40% given. You can write this out, guys. Then the tax base of a liability, we need to indicate to her, remember this is theory, will be the carrying amount for accounting minus the amount that will be not deductible in future. Okay, and then we need to indicate that the full allowance for the expected credit losses is not deductible. Therefore, the full allowance in terms of our scenario here, the 274,000 will not be deductible in future. Okay, therefore, when you look at our calculation, but guys, remember, you're not going to get marks. This 2740, this full amount will not be deductible in future. Therefore, our tax base will be 110,274 times 40%. Remember, no marks for the blue section, guys. Okay. If our tax base is 110, we will have a carrying amount of 274. Remember, this is a liability and a tax base of 110. If we look at this, our carrying amount of the liability exceeds the tax base. Okay, guys? If the carrying amount of your liability exceeds your tax base, basic principles here top of your screen, guys, this will be a deductible temporary difference and a deferred tax asset should be recognized. And this is the correction. We need to indicate this, that if our carrying amount of the liability exceeds the tax base of the liability, this will be a deductible temporary difference, and we may recognize a deferred tax asset if there will be sufficient future economic benefits. Let's move on. We can tick off number 6, and move on to number 7. Okay, so when you look at the deferred tax calculation, guys, number 7 will be our trade creditors. I'm going to make use of the screen, guys. You look at this. Number 7 in the notes, trade creditors relate to accounts payable to suppliers of goods. Okay, now when you look at the trade creditors, the first thing I have identified here is carrying amount, fine, but what about the tax base? Is this right? When you look at your principles, the tax base of a liability is the carrying amount minus the amounts that will be deductible in future. Okay, so guys, when we think about this, trade creditors, when we purchased the goods, this was already included in our expenses, which we have already deducted, remember, when we calculate our taxable income. Therefore, we have already received a deduction. We are not going to, when you look at your basic principles, we're not going to receive a deduction in future. This is going to be 0. Okay. Therefore, our tax base should be the 449. Therefore, we need to indicate that the tax base is incorrect. Therefore, the tax base of the creditors is incorrect. Okay. Why do we state this? Because the tax base of a liability is the carrying amount minus the amount that will be deductible in future. Now, if we look at creditors, it has a capital nature, and our tax base will be the carrying amount minus the amount deductible in future. Okay, guys, I'm just going to include my amounts for you to ensure that you understand. Our 479, let me just check this. No, 449, not 479. Okay, so we have our 449 minus 0. Therefore, 449, because the amount was already deducted. Okay, it was already deducted through our taxable profit or loss calc. Okay, and therefore our carrying amount should equal our tax base. Okay, let's move on. We can tick off number 7 and move on to number 8, which is our prepaid insurance. Look at the prepaid insurance line item. I'm going to make use of, let's say, orange, prepaid insurance, 59, carrying amount and tax base. Look at the note. It indicates as the prepayment relates to insurance premiums for the year ending on 30 June 2020. This prepayment was deductible when paid in cash in accordance with the requirements of section 23H. Okay, so guys, this is a prepayment. What is our basic principles? We've read the note. We now need to look at our carrying amount and our tax base. If you look at the tax base, the 59, okay, but this is an asset. Therefore, an asset, the tax base of your asset is the amount deductible in future. But they indicate to us that this was already deductible. This was already deductible. Therefore, if this was already deductible, you agree with me that our tax base should be 0. Okay. Therefore, the error here, and this is number 6, the tax base of the prepayment is incorrect. Okay, so why do we say this? Because we know that the tax base of our asset will be the amount deductible in future, but they have already indicated to us that the amount was deducted already, right? And this is in terms of section 23H, right? Let's move on. We can tick off number 8 and move on to number 9. Number 9, Rolling Wheels underwent a restructuring towards the end of 2019 and has a constructive obligation to pay severance packages to employees that will be retrenched during the following 6 months. Such will allow a tax deduction when it is paid, therefore in future. Okay. Now, when we look at our deferred tax calculation, provision for severance packages, we have our carrying amount 2889, tax base 2889. Okay, so let's just quickly think about this. This is a liability. Therefore, a liability, basic principle, carrying amount will be, the tax base will be the carrying amount minus the amount that will be deductible in future. Now, if you think about this, again, guys, let's just quickly recap our principle. Blue, you're not going to get any marks for this. The tax base of the liability will be the carrying amount minus the amount deductible in future. Now, they've indicated to us in the note that the amount will only be deducted once it is paid. You with me? Our carrying amount is 2889. Therefore, 2889 minus the amount that will be deductible in future. Therefore, this 2889 will be deducted in future, and our tax base should be 0. Therefore, the error is the fact that the tax base is incorrect. relating to our provision, and the correction is to indicate that the tax base of the liability is the carrying amount minus the amount deductible in future. They've indicated to us that the amount will only be deducted in future once it is paid. Therefore, our tax base should be 0, right? And then when we look at the rate, guys, provided the rate is the 28%, I can't identify any error with that. Okay, so we have now read number 9, and let's just tick off number 9 to be able to move on. Right, next, note 10. Okay, the cumulative assessed tax loss as at 1 July 2018 was carried forward from the prior year's tax assessment. Guys, I can't really see an error with that one though, hey? Because when we have tax losses, we can utilize this in the current year, except the fact that they've indicated to us in note 12 that does not expect to generate any taxable profits in the foreseeable future. Okay? Therefore, we can use the tax loss. We have an accounting profit. When you look at our current tax calculation, please, I'm going to make use of green, guys. We have our cumulative assessed tax loss. We have an accounting profit. Therefore, shop, we can still utilize this. Okay, but we cannot recognize a deferred tax asset if we expect no future income. 11. The cumulative assessed tax loss as at 30 June 2019, this is now the year that we need to look at, was calculated as 3451000. Note 11. The cumulative assessed tax loss as at 30 June was calculated as 3.4 million plus the 106,000. Now, we are able to identify that this 106,000 is in agreement with our current tax expense. Okay? When we look at this, note 12, Rolling Wheels does not expect to generate any taxable profits. Now, guys, I will include something in my correction by just stating here, I can't identify specifically if this is an error at this point of time due to the fact that I am not able to identify, or I have not recalculated. Look at this. I've not really recalculated with all of the errors. I have a total here, 167, okay, but I've not really recalculated this. Therefore, what I will do is I will include that they just need to be careful here that we may not recognize a deferred tax asset if they are not certain about future economic benefits. Okay, so I will indicate this because this is an important thing to note. Right, now when we move on, then we have note 13, tax rate is 28% and 80%. Okay, but guys, when you look at our current tax expense, remember we have now worked through our deferred tax. We have note 11 and 12. Look at this, note 11 and 12. They have included the assessed loss of 3,557. This 3,557 is the total of the 3,451 plus the 106. Okay, 3,557. Okay, they've included this here, which we can do because we do have sufficient amounts, deferred tax liabilities, to be able to use the 996. Okay, now when you look at this, our current tax expense, not this, sorry, when you look at the current tax expense, we have already indicated that the movement per the deferred tax calculation, this movement, guys, we do not agree with the fact that they have used the totals, the 730, because they need to split this. Okay, therefore I'm going to include in my error, and I'm going to call this my error number 9, that the movement in terms of my temporary difference included in my current tax calculation is incorrect. Okay, so why? Because that movement should only relate to my profit and loss. This should not include my OCI. This should not include my losses. Right, we've covered our deferred tax calculation, our current tax expense calculation, and now let's have a look at our tax rate recon. Okay, so when you look at our tax rate recon, guys, immediately with your eyes you will be able to identify. However, they did indicate to us that we don't have to recalculate. Okay, but we're able to identify that our tax rate recon does not recon. It does not balance. And the purpose is it has to balance. Okay, so when you look at this, guys, we have 6.97, the effective tax rate. And if we calculate our tax rate recon, we have 11.49. Therefore, immediately we are able to identify, guys, that this is actually an easy mark if you did not miss this. Therefore, our tax rate recon does not balance. We assume something is missing. Okay, now let's not that one, guys. Let's include this. Number 10, that our tax rate recon does not balance. Okay, but what is missing? Right, okay, so what is missing, guys, when we look at this? Okay, so you could have studied your template, or if you have a little bit of spare time, I know difficult, when you look at this, we have our assessed tax loss. Now I'm going to write in red, please follow me. Your deferred tax calc, assessed tax loss of 3557. Remember, this consists out of the 106 and the prior year's 3451. Okay, now if we look at this, we have our assessed tax loss, and we actually now use this, hey, against the 4287. Therefore, in our recon, we have now used the assessed loss. Therefore, this is also a reconciling item. Okay, because this has been set off against our taxable temporary differences. Therefore, in our correction, I'm going to indicate that we have our unrecognized deferred tax relating to 20.19, which we have now used against our deductible. No, guys, against our taxable temporary difference, and therefore this is a reconciling item. Okay, but I have to admit, I think this is a little bit difficult. Okay, so guys, what I quickly want to show you is when you look at your basic principles, the marks as per your solution for your basic principles, remember things that I really do think that you should know. I'm going to make use of red. Error number 1, by identifying the fact that they have included OCI. Guys, you need to know this. I have included this since the first test of our full program students, that your movement consists out of profit loss, OCI, and losses, right? Okay, therefore this is 1 mark. And then by indicating the correction, what they should have done, another mark, right? Okay, now in terms of our equipment, where they have the deferred tax liability basic principle, 1 mark. The correction, 1 mark. This is basic principles. Let's say, for example, you struggled with the IFRS 5 section. Okay, we leave this out. The allowance for credit losses, our tax base being incorrect. I really do think that you should be able to get that. Why? Because they've indicated to you in the scenario the 40%. They've indicated this to you. Therefore, another mark. The theory principle, another mark, your easy marks, right? Okay, number 5, our tax base of the creditor is incorrect. Why? Because this is basic principles. You should be able to receive that. You should be able to identify, I just want to move on my solution. You should be able to identify how to calculate that, at least another mark. Your tax base of your repayment, this is your easy marks, guys. Your tax base of the asset is the amount deductible in future, and the amount was already deducted. You should be able to get that. Okay, number 7, our tax base incorrect, guys. Basic principles. Basic principles in your correction. I really do feel that you should get that. Okay. The movement, if you were able to identify this link, well, I really do hope so. We have identified this quite a lot. You should be able to receive a mark and indicate what is the correction. It may not be included. And let's say, for example, the tax rate tax recon did not balance. I'm happy. Now, when you look at this, how many easy marks? 2, 4, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 15 easy marks out of the 27. Therefore, you should be able to pass this question by only focusing on your basic principles that you need to know.